Go.
Hello, our Markets of Capital presentation. My name is Will Murner. I will be attending UC Santa Barbara in the fall.
My name is Connor Fong, and I'll be attending the University of Chicago in the fall.
My name is Nolan. I will be attending Pepperdine University in the fall.
My name is Connor. I'll be attending UCSB in the fall too.
My name is Gianni, and I'll be attending University of Oregon.
My name is Aiden. I'll be attending the University of Wisconsin.
My name is Will, and I will also be attending the University of Wisconsin.
Given the nature of the virus, fiscal policy can only play a limited role in the relief of those struggling financially throughout the country. Unlike in previous recessions, where failure in some cause a recession, this virus has a sweeping effect on the entire economy and is causing financial issues in all categories. This negative effect is augmented by quarantine as the economy continues to suffer because of people's inability to work. This is coupled with the fact that no economic rehabilitation could take place until the progress of the virus has been slowed, makes the roles of fiscal policy extremely important in getting the economy back on its feet and offering relief for businesses and people who have lost their livelihoods. The first task, as stated above, is to slow the spread of the virus. In the short run, fiscal policy has a relatively minimal effect. However, by incentivizing pharmaceutical companies and by increasing spending to federal agencies, we can give them the opportunity to explore and test possible vaccines for the virus. Secondly, it is extremely important that there be sweeping relief efforts as many households and businesses suffer tremendously from the economic collapse. The unemployment claims have surpassed 38 million over the last 9 weeks, and a large proportion of households lack sufficient cash reserves prior to the outbreak of the virus. We recommend the government begins to provide funds for banks to make loans. By doing this, small and medium-sized enterprises who represent 45% of American business will have the opportunity to pay expenses until they are allowed to reopen. Similarly, unemployment insurance has an extremely important role in ensuring financial security for those who lost their jobs during this time. So far, the current program in place is inadequate, and so the relief package must try to augment this program and give more reliable income to those who are unemployed. Similarly, it is important that the legislature continue to fund and stimulate local governments to give them the necessary resources to fight the outbreak. Another important goal of fiscal policy is to support agriculture. Further, put in place policies that ensure the financial safety of those struggling, even if the virus exists for longer than expected. By strengthening and improving the relief efforts listed above, the government can offer a much stronger safety net into the long run. In summary, the government needs to be prepared to spend as much money as it takes in order to find this economic crisis and be unwilling to take increased hunger and bankruptcies as acceptable outcomes.
So in terms of monetary policy, the Fed has cut its federal funds rate by 1.5 points since March 3rd, the range now being between 0 and 0.25%. This aims at lowering the cost of borrowing on mortgages, auto loans, home equity loans, and other loans, but it will also reduce the interest income that savers get. The Fed has said that rates will remain low until the economy has rebounded from the effects of the nationwide lockdown and confidence returns that the economy can reach near full employment, putting downward pressure on long-term rates. In addition, the Fed has resumed purchasing large amounts of securities in an attempt to smooth the market functionality after Treasury and mortgage-backed securities became dysfunctional once COVID broke out. Fed initially said it would buy at least $500 billion in Treasury securities and $200 billion in government-guaranteed mortgage-backed securities over the coming months, but has since made these operations open-ended. For this term, we're calling it quantitative easing. Through the primary dealer credit facility, the Fed is offering low interest rates to 24 large financial institutions in exchange for equities and investment-grade debt securities, including commercial paper and municipal bonds as collateral, the goal of assuring that credit markets function during this time when institutions and individuals are hoarding cash and avoiding risky assets. The repo market is where firms borrow and lend cash and securities short-term, usually overnight. Disruptions in the repo market affect the federal funds rate, and this is the Fed's primary tool for achieving its price stability and employment mandate. Fed's facility makes cash available to the primary dealers in exchange for Treasury and other government-backed securities. Before the coronavirus broke out, the Fed was offering $100 billion in overnight repo and $20 billion in two-week repo. It has greatly expanded the program, both in amounts offered and the length of the loans. It is offering $1 trillion in daily overnight and $500 billion in 1 month and another $500 billion in 3-month repo. Now, with direct lending to the banks, the Federal Reserve is lending to depository institutions, which plays an important role in supporting the liquidity and stability of the banking system and the effective implementation of monetary policy. By providing ready access to funding, the discount window helps depository institutions manage their liquidity risks efficiently and avoid actions that have negative consequences for their consumers, such as withdrawing credit during times of market stress, as we are in right now. The Fed lowered the rate that it charges banks for loans from its discount window by 1.5 percentage points, from 1.75% to 0.25%, which is now lower than the Great Recession. These loans are typically overnight, meaning they are taken out at the end of the day and repaid the following morning, but the Fed has extended the term to 90 days. Banks have also pledged a wide variety of collateral, such as security, loans, etc., to the Fed in exchange for cash, so the Fed is not taking on much risk in making these loans. Additionally, the cash allows banks to keep functioning, so depositors can continue to withdraw money and the banks can continue to make new loans. Considering the current situation, we believe that the Fed has responded appropriately, and with its current plan, it should continue as it is.
Consumer spending is down in some areas, but certain sectors are enjoying growth, with frontrunners being the fitness industry and housing improvement industry. Still, PCE, personal consumption expenditures, is down 7.5% as of March, the greatest drop in PCE ever recorded. Personal savings are also worrisome, with 43% of Americans reporting loss of income due to the coronavirus, and that number jumps even more for lower-income Americans, with less than a quarter of this group reporting that they have sufficient money to survive sustained economic downturn. This lack of savings could predict further turmoil in consumer spending, especially if unemployment levels do not change. Given the uncertainty among medical research experts regarding the long-term significance of the coronavirus, keeping an eye on business confidence is equally important, as the longer the coronavirus persists, the more we should expect to see failing industries shrink and succeeding industries expand. As of March, business confidence has shrunk to levels lower than those of those lower than the 2008 recession. Though vaccination and treatment development could predict how safe reopening the economy is, Americans might doubt the accuracy of such information and choose to maintain quarantine-like restrictions on spending in certain sectors. Thus, following changes in aggregate supply and demand in failing industries such as the airline industry, the cruise industry, the movie theater industry, as well as less severely affected industries such as the beauty industry, the home furnishings industry, and the sporting goods industry could be a more effective tool in predicting a return to normalcy. Additionally, contractions in the gaming industry and online grocery industries, which have skyrocketed as a result in surging demand with minimal changes to supply, could indicate that consumers are returning to business as usual. Given the decrease in business confidence, net investment is also experiencing major changes. The Fed has worked to lower interest rates, as previously mentioned, but experts predict that maintaining credit for borrowing will pose additional threats to investment spending. Fiscal policy has been a primary focus thus far, with approximately $3 trillion being spent through 4 major pieces of legislation. Given that this recession has been imposed in part by the government, blindly stimulating the economy might undermine stay-at-home orders. Because the coronavirus's biggest impact has been mass unemployment, the CARES Act, which has allocated $1.8 trillion to businesses and individuals, is a vital component of the current fiscal policy. Trade deficits were at $501 billion in March, with 6.5% less import spending and 9.2% less export sales. Certain special items have turned from surpluses to deficits, with restrictions in international trading and unbridled growth in domestic demand. With the tremendous increase in select imports with the tremendous increase in demand for select imports like toilet paper, domestic businesses may face increased competition to sell their goods in those sectors.
What's going on in the markets? In late February, the S&P 500 lost 12% in 1 week due to the drastic shock of the coronavirus. And on March 23rd, the index reached its lowest point, almost 40% down from its recent peak, with an overall drop of over 1,000 points. The other prominent indices, like the Dow Jones Industrial Average and the NASDAQ, also followed suit. However, since this crash, and we saw the bottom in March, the S&P has seen a rebound of almost 32% from its low and is only down 8.5% on the year, with the NASDAQ actually being up on the year. Coronavirus has had severe impact on the economy, with essentially all transport, entertainment, and non-essential businesses closed for many weeks and people forced to stay inside their homes. The biggest impact has been on transportation businesses that rely completely on people going places, and these businesses have experienced severe declines and even bankruptcy, as seen by Hertz Car Rental just this week. The response of the financial markets has been mostly varied. The Fed has launched unprecedented amounts of quantitative easing, which has allowed the market to rebound. But it is clear that the gains have been caused by mega cap stocks referred to as FANG Plus, which is Facebook, Apple, Amazon, Netflix, Google, and plus means like Microsoft and other big ones. And those are soaring off market lows and carrying the S&P with them. There is an almost 60% discrepancy between the gains of the FANG Plus stocks and the entire market as seen by the graph. Because of their rise in value, just 5 stocks, Facebook, Apple, Amazon, and Google, make up 20% of the S&P 500, which skews the value of the index. This is most evident in the fact that these 5 stocks are up over 10% on the year, even with the decline, and the remaining 495 stocks in the S&P 500 are down 13%, which supports the fact that the 32% gain of the S&P off the March low is essentially just caused by these 5 stocks. The most important indicator that analysts should be looking at to gauge the overall health of the market is the RSP, not the S&P 500, because it is an equal weighted index, which means that all of the stocks in the index make up the same proportion of the index, so the value will not be skewed by just 5 companies that are doing extraordinarily well.
The unemployment rate and how it affects the economy. In March 2020, job reports showed that early impact of the coronavirus pandemic was much worse than economists expected, nor did they calculate it will signal further damage to the U.S. economy ahead. Calculated by the Labor Department's report, the U.S. economy estimated about 700,000 jobs were lost. The unemployment rate jumped to 4.5% from a 3.5% in February and is steadily increasing. During such times, almost 10 million Americans filed for unemployment insurance, stimulus checks, as strict social distancing guidelines took effect to curb the spread of coronavirus. Banks are forced to supply large amounts of funds to all their citizens, but banks are limited to a certain amount of funding and cannot cope with the large fluctuation of cash. During the financial crisis of 2007 and 2008, the government did not see that many citizens had terrible credits. At the same time, they gave out large amount of loans. Due to this, their unemployment rate hit a staggering 13.2%. Because of this, banks needed to either give other banks their collateral or suffer heavy losses. The unemployment rate does not seem like a factor that affects most of the world's economy. However, that is incorrect. If per se the unemployment rate is higher, the general income and therefore cash to spend will be limited. With less cash, people will spend less money, and there's less demand for products. This can mean that stocks prices can go down in many areas because there isn't as much demand for certain goods. An example as such, during low economic times, things like luxury items will go down in value. If you went around right now to buy gasoline at a local shop or a Costco, the gasoline prices have dramatically lowered since pre-COVID-19. This is because people merely are trying to survive and they don't have the money to go out or buy luxury items. A low unemployment rate can be an indicator for economic expansion. However, a high unemployment rate can be an indicator for an underperforming economy. But it goes beyond that. The unemployment rate is considered an essential indicator of the economy at large. But because the ripple effect that it has on the economy, value of the dollar and the stock markets decrease. A lot of people don't realize that the size of the unemployment rate might affect the Federal Reserves. They might raise or lower interest rate depending on whether the economy is doing well or not.
The California Association of Realtors have updated their sales and other information impacted by the coronavirus. California housing markets had a drop in sales, with April sales down 25.6% from March and 30.1% from a year ago. It is the worst month-to-month sales in the last 4 decades. Also, the California Association of Realtors unsold inventory index jumped to 3.4 in April from 2.7 in March and was unchanged from last April. Not only are the sales being on hold, but also mortgage rates fell to an all-time low level of just 3.13%. That is down from 3.8 at the start of the year and represents significant cost savings over the life of a 30-year loan. For buyers who can afford their monthly payments, The economic uncertainty that is driving rates lower provides an opportunity to capitalize on significantly reducing borrowing costs. Trading between foreign countries has also been affected, with the virus affecting shipments and materials costs increasing. This would pause any future projects from happening and make current projects difficult to continue. The Federal Reserve has issued an emergency 50 basis point cut to target interest rates. This policy will significantly reduce borrowing and make housing more affordable over the near term. Improved affordability stemming from lower rates combined with fewer new homes being constructed as the construction supply chain is impacted could lead to more upward pressure on home prices in California. Unsold inventory is already at low levels, and reduced construction activity means that this is likely to continue, especially if buyers respond to lower rates. Finally, I believe that analysis should continue to monitor unsold inventory and the sale percentages compared to last month and a year ago, as well as monitoring the demand for homes in the areas that had sharp decline in sales. In the short run, the market for housing will struggle, but in the long run will be beneficial with lower rates at an individual level.
Besides the traditional economic indicators, analysts should also pay attention to indicators that have to do with COVID-19 directly. Using epidemiological information to understand the current economy and financial markets may seem strange because medicine typically has almost nothing to do with economics. However, the primary cause of this current recession and unemployment spike has been the quarantine restrictions put in place to slow the spread of the virus, as well as the virus itself, as opposed to some economic cause. As a result, the progress of the coronavirus outbreak is heavily tied to the economy in these strange times. Once the spread of the virus has been slowed, states will start loosening up restrictions around which businesses can open and how those businesses operate. This reopening of businesses will provide a boost to the economy as well as reopening jobs, which will decrease the unemployment rate. The indicators that signal the status of the COVID-19 epidemic will be the testing rate, daily infections rate, and daily death rate. As of the 14th of May, 2020, the daily infections rate was at 23,619 new cases per day in the United States, and the death rate was 1,703 deaths per day. The death rate has dropped significantly from its highest value, which was 2,297 exactly 1 month earlier, and is still trending downwards according to those graphs. However, these numbers appear to be dropping. Analysts should watch them closely because any upward spike in these numbers will likely lead states to re-implement quarantine restrictions, which will slow or even reverse the progress made to recovering the economy. As of the 25th of May in 2020, at least 14 million total COVID-19 tests have been administered in the United States, and approximately 264,000 new tests are being administered daily. The daily test rate is trending upwards and is a good sign for both the pandemic as well as the economy, as the CDC has stated that adequate and continuous virus testing is essential to be able to open up safely. Analysts should view these numbers as a measure of how prepared the country is for further outbreaks. If the country is set up to handle future outbreaks, then the economic impact of such an outbreak will be less severe than if the country cannot handle them. Because when the virus is easier to track, fewer businesses have to be shut down, less restrictions will be put in place, and stocks are less likely to tank as they have in previous times.
And this is our completion of our presentation, and we are now open to questions.
Thank you for watching.